Welcome to Explain the Charts. Today is April 14th, 2026, and we have some monumental price action to discuss regarding the S&P 500. The headline of the day is that the S&P 500 has officially wiped out every single day of losses since the beginning of the Iran war. Closing yesterday at 6,886.24, the index staged a stunning 7.6% recovery from its mid-March trough near 6,400. Investor optimism is surging following a fragile ceasefire deal brokered by Pakistan, which has allowed markets to look past recent energy disruptions. However, it is not all smooth sailing, as dividend yields are currently sitting at 50-year lows of just 1.24%. Some analysts, like Robert Pape, warn that supply-side disruptions from the conflict could spill over into sectors beyond energy in the coming days. We also have the U.S. jobless claims figures and the CPI report coming up later this week, which will be the next major catalysts. Let us look at the big picture here on the one-day chart to see how this recovery formed. The daily candles show a clear V-shaped reversal that began in early April after a period of intense selling pressure. Notice how the volume surged during the initial bounce, indicating strong institutional accumulation at those lower levels. We are now trading back above pre-war levels, which acts as a massive psychological victory for the bulls. Looking at the long term, the trend remains decidedly upward, but the vertical nature of this recent climb suggests we might be due for a consolidation phase. Key resistance is now forming around the 690 to 695 level on the index, which we are testing as we speak. If we cannot break through 695, we might see a healthy retracement to test the newly established support at 675. To understand how we got here, we need to zoom into the late March period on the 1-hour chart. Between March 30th and March 31st, we saw one of the most significant intraday reversals in recent history. On March 30th, the S&P 500 was struggling, closing near the 631 level on the SPY as war tensions peaked. But look at the shift on March 31st, where price gapped up and never looked back, climbing towards 650 by the close. This move was driven by the first credible rumors of the Pakistan-led mediation efforts. Technically, this created a massive gap-and-go pattern that left bears trapped in short positions. The 1-hour chart shows that every minor dip since then has been aggressively bought up by traders. We saw a series of higher lows throughout early April, confirming that the short-term trend had completely reversed. Resistance at 655 was broken with ease on April 2nd, which further accelerated the short squeeze. During this period, the correlation between oil prices dipping and stocks rising was almost perfect. Traders were using the 1-hour EMA as a dynamic support line, which held perfectly during the April 6th and April 7th sessions. This tells us that the market had moved from a state of fear into a state of focused recovery. Now that we have reached the 680s, the momentum is slowing down just a bit as we approach the record highs. Now, let us bring it to the present moment by looking at the 15-minute chart from the last few trading days. On April 13th, the SPY opened around 677 and showed immediate strength right out of the gate. By midday, it had pushed through 680, which was a key resistance level we discussed in our previous update. The 15-minute candles show a very steady, controlled ascent throughout the afternoon session. There was a significant spike in volume during the final hour of trading, pushing the price all the way to 686.01. This power hour rally suggests that traders are willing to hold positions overnight, betting on more good news. Support has now solidified at the 682 level, which was the previous peak from the late morning session. If you are looking for a long entry, 682 is the first area to watch for a potential bounce. Below that, 679 is a much stronger floor that was tested multiple times on April 10th. On the bearish side, we have to watch for a potential double top formation if we fail to break the April 13th high today. The RSI on the 15-minute time frame is nearing overbought territory, sitting around 72. This suggests that while the bulls are in control, the risk of a sharp, short-term pullback is increasing. A break below 678 would likely signal that the market is ready to retest the mid-670s. Looking back at the daily chart, we can summarize our targets for the rest of the week. The most critical price level to keep an eye on is 692 on the SPY, which represents the next major historical resistance. In terms of predictions, I see a 60% likelihood of the market trending sideways to slightly up towards 695. This scenario is reinforced if the ceasefire holds and inflation data comes in at or below expectations. There is a 30% chance of a 2 to 3% retracement to the 670 level to fill some of the recent gaps. This would be healthy for the long-term trend and would likely provide a better entry point for long-term investors. The remaining 10% chance is a bearish reversal if the ceasefire collapses or supply chains show severe strain. Short-term traders should look for entries near 680, while long-term players may want to wait for a 675 test. Be bullish as long as we stay above 670, but turn cautious if we see a daily close below that mark. The dividend yield problem remains a dark cloud in the background, making this market very sensitive to interest rate talk. Keep your stop losses tight and watch the news feed for any updates from the Middle East. Thank you for watching Explain the Charts, and make sure to subscribe for our analysis of the CPI report later this week. Please note that this video is for educational purposes only and does not constitute financial advice. Always conduct your own research and consult with a professional before making any investment decisions.